Hey, what's up, you? Thanks for tuning in to another episode of the Trade Journals. This one's going to be on how to draw and identify support and resistance zones, as well as key levels. So, with no further ado, let's get right into it. So, what are key levels? Simply put, they're significant levels of support and resistance. So, support refers to a key level below the current price. That tends to slow or stop price, otherwise known as a floor. Resistance, otherwise known as like a ceiling, refers to levels above the current price that do the same. So basically, when price revisits these areas that invoked a strong reaction in the past, it tends to do so again in the future. And you can utilize these key levels to your advantage, either using them to, for instance, protect your stop, using them for your targets, or assessing them, using them to assess areas where you're likely to experience a headwind if you're riding a trend or something like that. So examples of areas that are possible support and resistance zones. So the most common is they're coinciding tops and bottoms. You can also think of like the top of a trading range or the tops and bottoms of a trading range. The high and low of the day often provide pretty key levels, support and resistance. Also, the locations from which really strong moves were initiated. Those are often important. Areas of confluence, when you get a number of things that are going to be matching up, like low volume nodes on the volume profile with the POC of another day. If you're not familiar with these terms, they come from the volume profile. If you're not familiar with it, with the profile, I highly recommend you do some research. We have a pretty good video on that as well. And then long-term highs and lows. Typically the longer the time frame, the more likely that key level is going to create a strong reaction. So here's an example of a support and resistance zone or key level. So you can see how price tends to respect this price. So we've got a bounce here, we have resistance here, bounce here, and then we've got resistance. So you can see that the market almost every time it approaches this level, it doesn't go through right away. It's slowing price down and sometimes deflecting it. So if you were, say, getting long here, you would know that this level is possibly a good place to take profit. You might consider front running it by a couple ticks, right down here or something, because that when price reaches this level, based on how it reacted in the past, it's likely to invoke a reaction. And you can see that it hit once, and then it tested it a second time and it failed, and then you see this really strong reaction where all the laggard longs, that everybody that bought up in here, they all get flushed out, and all their stops get hit. So, and then you can see we retested it here again, and then price broke down further, and we tried making a second run at it, and it just flushed everybody from this range out. So but yeah, you can see how it tests it usually multiple times, and when it fails, essentially you get a pretty significant move to the downside. So you can also use these for your entries too. Like if you're trying to get in short and you know that this level right here is likely to produce a reaction, you might be watching for an entry right here, and when you see it test it, you see all these wicks, 1 2 3 4 wicks, something like that, where it tried to break up but it couldn't. You might just be watching for signs of failure and then enter on the short side and catch a pretty nice run. When I first started drawing these guys, I struggled with probably drawing too many levels and having a hard time assessing which ones were the really important ones and which ones were not quite as important. So typically, you want, I'm going to go back to the last slide for a second. You can see how this line is really well respected. Like, you have some very clear breaks and bounces off of this level, whereas this line, like, yeah, you could consider it a support and resistance zone, because you do have some areas like here, where it was getting a reaction, but you also have like right here where it just traded right through it. Same thing. It looks like there is a wick right there, but like right here and right here, like, yeah, you're getting some reaction, but it's not nearly as defined as this other level. So basically, the strength of the support or resistance is usually reflected in how well price tends to respect that level. So if it's trading through it a lot and it's not stopping before it does so, like right there, that's not a very good, like, if I didn't have all this other stuff to match up, this would not be a key level because price went right through it right there. So what are they good for? So for one, they're really, really good at protecting your stop, because price doesn't typically want to break through them very easily. It's a great way. It's a great place to put your stop on the other side of a key level, because price is going to have a much harder time getting your stop that way. So yeah, by putting your stop on the other side of a key support or resistance level, you can lean on that area, ensuring that the market will have to work particularly hard in order to get your stop. You can also use key levels to identify where price is likely to struggle, and this is really helpful in identifying where your target should likely go. Typically you would want to front run a support or resistance zone by a couple ticks. That way, and also it's helpful in assessing the risk and reward of your trade, because if you're entering at 33.50 and you know that there is a long-term resistance level at 33.55, you probably wouldn't take that trade, because there's not very much headroom. Your trade is not going to go very far basically before it runs into resistance, so you might be less apt to take that trade. So they are really good for targets, because a lot of the people that create major moves in the markets will often target them themselves, and they'll want to push prices all the way up to that level. They also work in any time frame. In fact, the higher the time frame, the level, like I said before, the stronger that level becomes. So key levels on the daily chart or the weekly or monthly charts are very, very profound. They are much more likely to produce a very big reaction or more major change. Whereas if you have levels on the 1 minute chart, they're not nearly as strong, and yes, they do matter, but you're not gonna likely see a major move after bouncing off of a 1 minute level versus a daily level. So this chart is basically just about how you can use them to place your stops. So say if I was trying to get long down here, I would put my stop right below this level basically, or maybe one tick beyond this, because price is going to have, as you can see, has a hard time breaking through this level. So I would put my stop right down here. Same thing if I was trying to get long in this area. I know that there's resistance which turned into support here. So once we break through it, it's going to want to retest this level, and if you put your stop right below it, you're likely to it's less likely to be hit. So same thing down here, up here. So it's really good to mark this stuff out, ahead of time. Like I do, I mark my key levels every day before the market opens. So when the heat is on and you're in the moment and emotions are running high and stuff, you don't have to think, like you already have it plotted on your chart. So by the time price gets up to it, you already know that this is a significant area and you're not going to get run over because you didn't identify a crucial point. So this is kind of what I was talking about headroom. So, we can expect that key levels are going to slow or sometimes stop prices, right? So, like, you wouldn't necessarily, oops, sorry about that. You wouldn't necessarily want to get in right here because you know that your next resistance level is right up there. And you can see how many times the market chopped around between this area. I mean, there's just like wicks all over the place. And, you're really only going to get like a couple points basically before you have to either get out. Because, if you got in right here, I mean, that's just the risk and reward is not very good. Whereas like down here, if you're entering at this level, I mean, there's quite a bit of headroom. I mean, it could be argued that this level in here could be support and resistance. But yeah, I mean, you can just see the strength of these moves. The prices are moving pretty fluidly between these levels. So I mean, you're just getting a much more dynamic move in this area versus in here where it's extremely choppy with lots of overlapping bars. So this is what I was talking about in using them to pick your targets. So like, for instance, if we were to get long right here, you've got plenty of headroom, so that would be your exit. Or if you decided to hang on, anticipating the possible break, you might stick in until right about here. And then of course with resistance turning into support, it's going to come back and retest. We can see it's from right here. It's going to retest this level, so this is a good long entry. Then you could either take profit right at this previous pivot high or anticipate the break and try to hang in there until this prior high, basically. So you guys get the idea, right? It really depends on your level of confidence. This is why I like to trade multiple contracts, and I trade futures. If you trade stocks, multiple shares, whatever. Because, like, let's say I'm getting long right here, and I know that there's a key resistance right here. I would enter long with, say, 3 contracts or 3 shares or whatever you trade, and I would enter here, take off 1 contract here or 2 contracts or whatever, and then hold my other ones until I got up here, most likely. So it really just depends, but I mean, when you use multiple contracts, it's helpful in that regard, because if you had taken off your full position right here, well, heck, that thing went way, way further. So anyways, and then yeah, like I mentioned before, resistance turns into support, and vice versa. So you can see we've got resistance here, which turned into support here, and there's a wick you can see. So it's it doesn't really matter whether you're approaching the level from below or above. It's still going to provide support and resistance. So all right, so let's go to the live chart and see if we can't find some real life examples. So we're looking at the ES, the S&P 500 futures, and I'm just kind of going to go through and mark off some key levels and kind of explain why and whatnot. So I typically will always look at the high and low of the day. So I can see right here we have one, and even though this is it doesn't really have any more confluence, like by confluence I mean like matching areas, I would still mark this because this is a huge drop. So typically the more of a spike that it makes, the stronger that support and resistance is. Because if you think about it, you know, the market had a ton of momentum coming down here, and then it found support, found buyers, or whatever. And then this candle, I mean, it pushed all the way down, and then it closed all the way back up here. So there was a lot of buying that took place at this level. So it just goes to show that this level was really heavily defended, basically. So like I said, the more spiky it is, typically the stronger it is. What else we got here? Let's see. So right here we got one, and I realized that price didn't respect it very well right in here. But you know, it's still a good level to mark. You could see it did kind of wick here from below, and kind of wicked from above. So it really depends. Like, you might kind of wiggle it around a little bit and find that you kind of like that better. So I mean, it really is. There's definitely some subjectivity to it, but you just kind of want to like put it where you feel like it fits best. And what else we got? I mean, this kind of works. It did bounce quite a bit up here. Definitely that. And let's see what else we got here. So you can see how this level from before, like we marked this right in here, and you can see it's still respecting it over here. And that's the power of these things, you know, because if you know this is a key level right here, and you saw this bounce, you know, you might be waiting for this big old thing to bounce down here and then pick your long entry. And if you miss the first one, no big deal. Why? Because you got a second and a third chance, and it respected it all 3 times. So I'm not seeing anything else. Very definitely that. And does that fit? Not cool. I mean, a little bit. This would be one of those ones where I would say it's kind of on the fence. But yeah, you can see it's got some confluence there. What else we got here? Let's keep going higher. We're getting interesting. Okay, so these, I would definitely mark that. That's a good high. And also, when you get highs like this is kind of off topic, but when you have a high like this that has been tested 1, 2, 3, 4 times, I always call it like the battering ram principle. Like, the more times you bang on a wall, the more likely it is to break. Some people think that, if it held price 4 times, that must mean it's really strong. No, it doesn't work like that. Because it's been tested so many times, it basically means that this level is suggesting greater and greater levels of price acceptance. So because this is starting to look more and more like the accepted price, the more likely it is to break. And that was counter to the other spike we had from the very beginning. Like, the market did not spend hardly any time trading down here. So basically, because it spent hardly any time trading down here, it basically infers very low levels of price acceptance. So it's a pretty strong trend, so there isn't really a ton. Sometimes I'll do something like that where you get really long wicks. I'll do like kind of by the close and then also right at the tips. And that's a good one right there. So anyways, you guys get the idea. And like I said, you can also take it over to the daily charts. You know, these are going to be the really important levels that you really want to watch out for. And basically what I'll do is, if I have a key level on the higher time frame, I will double click it. And if you see right here where it says attached to, this is in NinjaTrader 8. You can see this is the chart we're on the ES. This is a daily chart basically, but my volume profile needs minute-based charts, so that's why it's the 1440 minute, which is 1 day. So if you click on that, you can change it to all charts. So now this level will be visible on every one of my charts, whether I'm on the 1 minute or if I'm on like a 5 minute, or I guess it's the 30 minute, or whatever. So, and also what I'll do is I will color it differently. So my really high time frame charts are going to be in cyan, and then my lower time frame charts I'll do in magenta, something like that. So that way, if it gets to that level, I know it's something that's really crucial you pay attention to, basically. But that pretty much wraps it up. If you guys have any questions or anything, feel free to let me know in the comments. Yeah, I mean, this stuff, it does take a little bit of practice. There's definitely some subjectivity to it, but it's an extremely important part of trading. So you know, get some practice in, pull up some charts, mark some lines up, and you'll get the hang of it in no time. So but yeah, thanks for tuning in, guys, and we'll catch you next time. Take care.